people anticipate lower and higher returns is a function of their psychology.
Rhythm, I had many discussion with other analysts on this, and I keep saying that in my view, airline stocks represent the huge discrepancy between price and value.
Yeah.
If you look at the market cap getting of a few thousand crores, and you have one airline, Indigo, announcing a $16 billion order.
Yes.
Now, businessmen don't order aircraft unless they can make money or get a return on capital. And the entire sector is available, which is going to grow at 20-25% for the next few years. It was at a few thousand crores, maybe now it's at 5,000 crores or 8,000 crores.
Yes.
So, isn't there a discrepancy between price and value, and isn't it that hard that you tell people about it and no one will agree with you?
Absolutely. I mean, it's happening into banks right now, for example. Take the case, 4 months ago, everybody wanted to buy bank stocks because that was that's the best thing in town. And now nobody wants to buy them. And really speaking, if you look at the business models of India's largest banks, nothing has changed materially except that, there may be some NIM compression coming for the next 2 quarters.
Right.
That's not going to alter the value of the stock dramatically as much as the stock prices have fallen. So
and the fact that as GDP grows, deposits will grow and basic franchises.
Yes, but there is now a big question mark whether all these things are going to happen. So that then immediately highlights a potential gap between price and value, and you should start examining that. Ditto for airline stocks and even for real estate stocks. I would argue that there is a potential gap between value and price that's building up, and discerning investors who have a longer time horizon may actually end up making money on some of these stocks.
I've said this before, I'll say it again. T. Boone Pickens, one of the great oil drillers in the West, said that how did he become rich? In the 70s, he said he drilled for oil in Wall Street rather than going out because stocks were so cheap with existing reserves on the ground, and that's the way to buy it. And that's the true measure of creating wealth. Buy things cheap in the dollar.
Yeah, that's the only place in the world where you can actually buy real assets at a discount,
right,
to their intrinsic value, and sometimes pay a massive premium to their underlying value.
Yeah.
So that's the only place. That's Wall Street.
And if you do it right, if you buy it at that massive discount, you can become fabulously rich.
Absolutely.
Talking about rich and poor, Keynes, an economist you admire, Nirmal, I know, said markets can remain irrational longer than you can remain solvent.
This is very interesting anecdote, and I'll tell you a story which is not Indian but is very relevant. This is in the middle of 19th century when steam engine was discovered, and the iron ore and coal were in Russia, and the industrial revolution was taking place in Europe, and the only way to transport iron ore and coal were railroads. So everybody thought that railroad is the best sector and the best stocks to back, and most of the American investors invested money there. And there are some smart investors, say middle of 19th century, they said that this is stupid because there's a high fixed cost and you are building over capacity, and maybe nobody will make money. 30 years after, all the railroad companies went bankrupt, and but the fact of the matter is that when you're looking at NAV from month to month or year to year basis, many of those fund managers lost their jobs, and actually many of them did not live long enough to see that what they thought was right. Okay. So this can happen in the market all the time, and we have seen that in real estate market also for last few years, and I mean for 4 or 5 years we have seen trends in IT sector, we have seen trends in real estate sector, all the sectors.
The prices keep going higher and higher.
Yeah, it can remain irrational for much longer than what you can be prepared to.
Last quick one that I want to get by you, Rhythm. It says Wall Street indices predicted 9 of the last 3 recessions.
Yeah, no, that's a very interesting one. I think it just basically highlights the market's emotional nature. The market is a very emotional animal. It's almost like a living being, and it moves for cycles of greed and fear. So it gets exuberant and it starts predicting economic booms, and then it gets very depressed and starts predicting recessions. We are kind of getting to that stage here in India where the market is already starting to build a sharp slowdown in growth for whatever reasons. But the real economy doesn't actually move in that sharp gyrations. The gyrations are much smoother, and the cycles are much longer. So the market does tend to have a lot more volatility, and investors should be aware of that it doesn't necessarily mean that an economic recession or a boom is coming. And it actually, this one contradicts the earlier one that we talked about, not fighting the tape, which is that the market always has something to tell you which you better listen to.
Right.
So we have to be cognizant that it works both ways.
Know when to apply which
exactly.
Nirmal, last word from you.
I'll talk about greed and fear, which is the most cliched and most oft used maxim. But for a typical investor, it is always with hindsight that he knows whether the mistake was greed or fear. Because say a stock has moved up from 10 rupees to 100 rupees, I was talking about Jindal Steel and Power,
Right.
or there are many other stocks. So from 100 rupees, if you don't sell, then it's greed, but the stock may go up to 400 rupees.
Right.
And the stock can come down to 50 rupees also. So whether you should have acted based on greed or fear, you'll know with hindsight.
Hindsight is 20/20.
Yes. So practically speaking, most of these magazines also require a lot other information, a lot other.
It requires wisdom. It requires distillation of watching markets, reading
Exactly.
over markets, thinking. You know, you can't apply a maxim without context, obviously.
That's right.
I like what Mark Faber calls his news report always. You know, the gloom, boom, doom report. You know, so markets will always go through those phases. You know, there'll be utter pessimism, there'll be abject euphoria, and then there'll be a collapse in the market. Rhythm, Nirmal,
And that's why all of us have jobs. Thank you.
Clearly, we're employed thanks to that, and on TV. Rhythm, Nirmal, thank you very much for being a part of RD360. We'll see you next week on another episode of Money Making Maxims.